Welcome to Tikona Capital's comprehensive market outlook for October 2025. We are driven by deep research, built on strong networks, and act with conviction. Our mission is clear: to empower you to invest in high-quality businesses and build sustainable long-term wealth. Let's explore what lies ahead. At Tikona Capital, we provide comprehensive wealth solutions tailored for working professionals, HNIs, and family offices. Our offerings include equity model portfolios, mutual fund solutions, differentiated PMS, unique AIFs, unlisted equities, startup investments, and IPO advisory, everything you need under one roof. Before we begin, important disclosures: Tikona Capital is SEBI registered as a research analyst. All investments in securities markets are subject to market risks. Please read all related documents carefully before investing. This presentation is strictly for educational purposes and should not be construed as financial advice or a solicitation to invest. Happy Diwali to all our clients and partners. This festive season, we encourage you to illuminate not just your homes, but your family's financial future. At Tikona Capital, we are committed to helping you create wealth that truly protects and empowers the people who matter most to you. Our comprehensive October outlook examines 7 critical themes shaping the investment landscape: global growth expected to moderate in 2026, the transition into a new monetary easing cycle, fiscal dynamics with high spending and higher stakes, debt market opportunities, equity market positioning, our refined investment strategy, and finally, curated wealth creation ideas specifically designed for current market conditions. Looking at the global economic landscape, GDP growth is projected to moderate in 2026. World growth is expected at 2.9%, with the United States slowing to 1.5% and the euro area to just 1%. However, India stands out brilliantly with a robust 6.2% growth forecast, significantly outpacing developed markets. The key concern? If current tariffs remain in place through 2026, US-China trade will likely shrink substantially, while China increasingly redirects its exports toward emerging markets in the global south. The trade war between the US and China has escalated dramatically. US tariffs on Chinese exports have climbed to over 30%, while Chinese tariffs on US goods sit around 19%. This has fundamentally reshaped global trade flows. Look at the transformation. In 2015, China's trading partners in the global south represented just 32% of its merchandise trade. By 2024, that figure has surged to over 42%. The US share has fallen from 14% to just 11%. This represents a historic rewiring of global supply chains with profound implications for emerging markets and investment strategies. After an aggressive tightening cycle that saw rates peak above 5%, the Federal Reserve has pivoted. Following a 25 basis point cut in September, Fed officials project the end-of-year rate to fall between 3.50 and 3.75%, with further cuts anticipated. This is not just routine policy adjustment. Markets may be witnessing the early stages of a comprehensive policy reset specifically designed to sustain economic expansion and avoid recession. The timing and pace of these cuts will be critical for both bond and equity markets globally. This easing cycle could last well into 2026. India is rapidly emerging as the world's primary growth engine. By the 2025 to 2030 period, India is projected to contribute nearly 19% to global GDP growth, more than any other nation. Just look at the quarterly GDP performance, consistently growing between 5.5 and 9.7% with remarkable resilience. India's share in global GDP is expanding steadily, and its growing global footprint across trade, investment, and innovation places it on a trajectory to become a cornerstone of global economic resilience for decades to come. This is the structural story underpinning our investment thesis. Let's drill into India's macroeconomic fundamentals, which remain exceptionally strong. The composite PMI stands at an impressive 61, well into expansion territory, with manufacturing at 57.7 and services at 60.9. Core sector production surged 6.3% year-on-year in August, a 13-month high, driven by steel up 14%, coal up 11%, and cement up 6%. Industrial production is growing at 4%, led by infrastructure and construction goods. Most remarkably, CPI inflation has collapsed to around 2%, well within RBI's target band, providing significant policy flexibility. The trade deficit remains manageable at $26.5 billion with the services surplus partially offsetting merchandise gaps. Across the board, India's macro picture supports continued growth. GST collections for September 2025 reached 1,89,000 crore rupees, registering healthy 9.1% year-on-year growth. This reflects resilient economic activity despite market expectations of GST rate cuts potentially dampening collections. The consistent performance, from 2,01,000 crore rupees in May to stable collections through the quarter, indicates steady domestic demand and improved compliance. Going forward, we expect GST collections to remain robust, supported by continued domestic consumption, enhanced compliance infrastructure, and the ongoing recovery in services activity. Let's now turn our attention to the debt markets. With inflation easing dramatically and liquidity conditions improving, the outlook for fixed income is turning increasingly constructive. Here's what bond investors need to know. In its October policy meeting, the RBI Monetary Policy Committee unanimously held the repo rate steady at 5.50%, reaffirming confidence in the economy while adopting a neutral stance by a 4-2 majority vote. This follows a cumulative 100 basis point rate cut since February 2025, and now represents the second consecutive policy pause. The standing deposit facility remains at 5.25%, marginal standing facility at 5.75%, and bank rate at 5.75%, providing continued support for liquidity and credit growth. Most significantly, inflation has eased sharply with CPI now projected at just 2.6% for FY26, while the current account deficit has narrowed to just 0.2% of GDP. Record FDI inflows highlight India's extraordinarily strong macroeconomic fundamentals. The inflation picture has improved dramatically and is now decisively favorable. Headline CPI inflation has fallen to around 2%, with the RBI lowering its full-year FY26 forecast to 2.6% from the previous 3.1% estimate. Both headline and core CPI are trending well below the RBI's 4% target. Food inflation has actually turned negative due to favorable vegetable prices, subdued commodity costs, and beneficial base effects. With inflation comfortably below target and growth remaining solid, the monetary policy stance may turn incrementally more accommodative by early FY27, providing additional support to economic activity. Here's a critical insight for bond investors. Yields are now influenced more by the quantum of durable liquidity that the RBI maintains than by rate cut expectations alone. We saw this dynamic play out recently, when system liquidity rose above 5 trillion rupees, long-term government bond yields actually fell even without an accompanying rate cut. This demonstrates that liquidity itself can effectively guide the entire yield curve. Looking ahead, if liquidity remains around 2% of net demand and time liabilities through the second half of FY26, supported by RBI operations and steady government spending, we expect 10-year government bond yields to trade in a stable 6.4 to 6.6% range, with a mild downside bias if policy turns softer or liquidity conditions improve further. This creates an attractive environment for duration strategies. Gold is delivering exceptional performance and now outperforming all major equity markets across the world, a remarkable feat for a traditionally non-yielding asset. In developed markets, gold has generated excess returns over equities ranging from 0.7% to 7.3% in the 21st century. In emerging markets, the outperformance is even more striking, from 0.3% in India to 9.6% in Turkey. Within major indices, 30 to 35% of stocks have underperformed gold over the past 20 years. The structural drivers remain firmly in place. Deglobalization pressures, sanctions risk, and reserve diversification will likely keep emerging market central banks reallocating toward gold, extending the powerful structural bid we've seen since 2022. Maintain a long bias. We're witnessing a historic transformation in global reserve composition. For the first time since 1996, foreign central banks are now holding a greater share of gold in their international reserves than US Treasury securities. Gold has climbed from just 13% of reserves in 1970 to 24% today, while US Treasuries have declined from 48% at their peak to just 23%. This isn't temporary. With ongoing de-dollarization pressures and continued reserve diversification strategies, central banks are likely to keep adding gold on net while trimming marginal treasury holdings. This structural shift keeps gold's share of reserves on a sustained upward trajectory over the next year and beyond. Currency movements remain volatile across major pairs. Over the past month, the Indian rupee depreciated 1.3% against the dollar, moderate in comparison to peers. Year to date, the INR has weakened 2.4%, performing in line with regional currencies like the Indonesian rupiah and Vietnamese dong. With ongoing monetary policy divergence globally and persistent trade tensions, we expect currency volatility to continue in the near term, requiring active monitoring and hedging strategies where appropriate. Now let's dive into equity markets. Despite recent consolidation and volatility, India's underlying structural growth story remains firmly intact. The question is, where do the best opportunities lie in the current market environment? Let's examine the evidence. Mutual fund performance in September revealed distinct patterns across categories. In equity funds, value and dividend yield strategies held strong with impressive 3-year returns near 20%, with value funds leading 1-month performance at 1.3%. Large and mid-cap funds maintained robust 3-year gains around 19% despite weak 1-year returns. In hybrid categories, silver and gold funds dominated. Silver funds delivered a spectacular 17.2% in 1 month backed by stellar 56.8% 1-year returns, while gold funds posted 10.3% monthly returns. In debt, the gilt fund with 10-year constant duration topped 3-year returns at 8.5%, while dynamic bond funds delivered steady mid-single-digit 1-year gains. Thematic funds saw PSU and transportation themes leading 3-year performance with 25 to 30% gains, while international themes topped 1-year returns at nearly 17%. September delivered mixed performance across global and domestic markets. Globally, Nasdaq led the charge with 6.5% monthly gains and stellar 24.6% 1-year returns, while Hang Seng and HSCEI posted 4.8% monthly gains with over 27% 1-year performance. Indian markets showed consolidation. The Nifty declined slightly by 0.1% for the month but maintained respectable 15.8% 3-year returns. Within India, Nifty Next 50 rose 1.8% but remains down 12% over 1 year. The real star? SMEIPOS, which despite a 2.3% monthly dip, have delivered an extraordinary 83.7% 3-year return, highlighting the explosive growth in India's small and medium enterprise sector. Among strategies, Dividend Opportunities 50 led with 18.8% 3-year returns, while Momentum 30, Quality 50, and Value 20 indices held moderate long-term strength between 13 to 17%. Market flows in September showed the familiar tug-of-war continuing. Foreign institutional investors withdrew 18,927 crore rupees, extending their selling streak, but this was more than offset by robust domestic institutional investor buying of 44,582 crore rupees. Mutual fund flows turned negative with 43,146 crore rupees in outflows, though SEEP contributions remained strong at 29,361 crore rupees, demonstrating retail commitment. Primary market activity was exceptionally strong. Mainboard IPOs raised 12,449 crore rupees from 21 companies with an average subscription of 44 times, while SME IPOs raised 2,492 crore rupees from 57 companies with a remarkable 56 times oversubscription. Strong domestic flows and record capital raising continue to offset volatile fee trends, providing crucial market support. Valuation metrics reveal that markets are trading near their long-term historical averages. The Nifty's 12-month forward PE ratio stands at 20.6 times, slightly below the 10-year average of 20.7 times. The trailing PE is at 23.2 times compared to a 10-year average of 22.5 times. On the price-to-book front, the 12-month forward PB is 3.1 times versus a 10-year average of 2.9 times, while the trailing PB is 3.4 times against an average of 3.1 times. With valuations hovering around these long-term means, future market performance will likely hinge primarily on earnings growth rather than multiple expansion. This makes earnings quality and growth visibility absolutely critical. The divergence between foreign portfolio investors and domestic institutional investors continues to shape market dynamics. FPIs face significant headwinds, negative returns over the last year, underperformance relative to emerging market peers, last 5 quarters of APE's growth stuck in single digits, valuation premium compared to peers, adverse impact from US tariffs, and continued IPO and keep supply pressure. In contrast, these benefit from powerful tailwinds. Outstanding outperformance over the last 10 years, acceleration in earnings growth expected in FY 27 driven by domestic fiscal stimulus, reform initiatives designed to negate adverse tariff impacts, structurally higher return on equity than peers, and India's immense long-term growth potential. This dynamic, strong deflows and reform-driven growth, is likely to keep India's markets resilient even amid FPI volatility and global headwinds. 2025 has witnessed accelerated IPO activity with a pronounced surge in the second half. January saw 6 IPOs, but the pace accelerated through the year. May had 6, June had 8, July surged to 13, August maintained 12, and September saw a remarkable 18 IPOs announced. This acceleration in mid-cap and SME offerings highlights significantly improving capital access beyond just large corporates, robust investor appetite across the risk spectrum, and strong entrepreneurial momentum. The primary market boom reflects confidence in India's growth trajectory. With this comprehensive market backdrop established, what should be our investment strategy going forward? With state elections approaching, festive demand building, and market depth expanding, here's precisely how we're positioning portfolios for the critical months ahead. State elections are approaching and will serve as a significant fiscal catalyst. 6 major states, Bihar this year, and West Bengal, Kerala, Tamil Nadu, Puducherry, and Assam, go to polls in May 2026. These states collectively represent 23% of total state expenditure, 16% of state subsidies, and 17% of state capital expenditure. Pre-election dynamics typically drive a near-term shift in subsidy allocation and capex priorities, influencing overall fiscal dynamics. Expect targeted fiscal stimulus, increased welfare spending, and infrastructure announcements, all of which should provide consumption tailwinds in benefit sectors like FMCG, consumer durables, construction, and cement. Monitor state budget announcements closely for investment opportunities. India's festive season, running from Ganesh Chaturthi through Diwali and into the new year, represents the single most important quarter for consumer-facing businesses. This period accounts for approximately 25% of annual revenue for consumer-focused sectors, with retail deriving 26% of annual revenue, consumer durables 25%, FMCG nearly 25%, and travel and hospitality a remarkable 28%. Historical data from FY 15 to FY 25 confirms this pattern consistently. With rising disposable incomes, deeper digital penetration reaching Tier 2 and Tier 3 cities, expanded credit availability, and strong employment growth, India's upcoming festive seasons are poised to set new consumption records across automobiles, electronics, apparel, jewelry, e-commerce, and hospitality. Consumer durables valuations have moderated and look attractive on a relative basis. Consider this striking fact. India's total market capitalization has grown from 132 lakh crore rupees in June 2020 to 387 lakh crore rupees in June 2025, nearly tripling in just 5 years. Today's small cap segment, with the 250th company at 10,300 crore rupees market cap, is now bigger than the entire mid-cap bucket was in 2020, where the 150th mid-cap stock had just 7,000 crore rupees market cap. This dramatic expansion suggests it's time to fundamentally expand India's mid-cap universe definition. Doing so could unlock broader investment opportunities, significantly improve market liquidity, reduce concentration risk, and align valuations more closely with the country's accelerating economic momentum. Market infrastructure needs to evolve with market growth. After an entire year of persistent earnings downgrades, sentiment has finally turned decisively positive. The BSE 200 Earnings Sentiment Indicator, measuring the number of upgrades minus downgrades relative to total estimates, has swung from deeply negative 30% territory in late 2024 to positive territory in September 2025. This is the first sustained positive reading in over a year. For Q2 FY26 specifically, Nifty 50 index revenue is expected to grow a healthy 7% year-on-year, with EBITDA rising 8% and profit after tax up 6%. EBITDA margins are projected to expand to 21.1%. As corporate operational momentum builds and capital expenditure cycles gain traction, a sustained pickup in earnings upgrades could drive renewed market leadership in cyclical and growth-oriented sectors. This is the key catalyst to watch. Our sector-by-sector outlook is nuanced and differentiated. We have a positive outlook on autos and auto ancillaries. Valuations are near 10-year averages at PE of 26.5 times, and demand recovery is being aided by GST cuts, normal monsoons, easing interest rates, and improving rural sentiment. Expect festive season volume pickup across passenger vehicles and two-wheelers. We are moderately cautious on banks. Loan growth is steady but net interest margins are compressed. Funding cost relief from RBI rate actions may lift margins in the second half. We maintain a positive bias on NBFCs where ARM growth is strong. Funding cost easing should support spreads. Our outlook on cement is constructive. Demand remains steady with disciplined pricing and capacity additions supporting earnings through FY26. For technology, we're neutral. Valuations are reasonable but structural demand uncertainty persists with Gen AI-led pricing pressure. We're cautiously positive on metals given recent volume recovery, though global demand remains uneven. Healthcare remains our defensive pick with upside. Hospitals show strong growth and stable margins near 70%. For chemicals, we see gradual recovery as margins improve in specialty chemicals, though global demand remains uneven. Overall, we favor domestic cyclicals and consumption plays over globally exposed sectors. Let me share our curated wealth creation ideas. In mutual funds, consider the Invesco India Mid Cap Fund Regular Growth, with AUM of 8,062 crore rupees. It has consistently beaten both category average and benchmark with returns of 7% over 1 year, 26.6% over 3 years, and 27.4% over 5 years. While the category averaged negative 0.6% for 1 year. SEEP returns are an outstanding 47.8% annualized over 3 years. Also examine White Oak Capital Flexi Cap Fund Regular Growth, with AUM of 5,743 crore rupees. It has delivered 2.3% 1-year returns when the category was negative, and 18.5% 3-year returns against a category average of 17.1%. With SEEP returns of 29.6% annualized. For fixed income, look at Cholamandalam Investment and Finance Company's 8.75% listed subordinated debentures maturing in May 2030, offering an indicative yield to maturity around 8.40%, rated ICRA AA+, with annual fixed interest payments. This provides strong credit quality from a large diversified NBFC with solid scale and listed liquidity. For sophisticated investors seeking alpha, consider unlisted opportunities. The National Stock Exchange of India, currently trading around 1,925 rupees per share with DRHP not yet filed, is the absolute backbone of India's capital markets, controlling over 95% of derivatives trading and ranking among the world's top exchanges by volume. It generates extraordinary profitability with 80% operating margins, 22% return on equity, and zero debt. Premium valuations of PE around 42 times and price to book of 17 times reflect the market's recognition of its monopolistic position and India's massive ongoing financialization wave. Also consider Grove, Next Billion Technology, currently around 128 rupees, India's largest digital investment platform with nearly 48 million active young users and a pan-India presence. Market cap of 76,268 crore rupees with PE of 41.8 and ROE of 37.6%. Multi-product revenue streams across brokerage, loans, mutual funds, bonds, and margin funding provide diversification. For structured products, examine Nifty-linked market-linked debentures from Incred Capital offering 150% upside participation uncapped with negative 20% principal protection, or gold-linked MLDS offering 570% participation up to 57% gains with full 100% capital protection at maturity. To summarize the macro environment, globally, Fitch projects 2025 world GDP at 2.4% with the US slowing and China and the Eurozone showing modest improvement. The ECB confirmed its rate pause on September 11, emphasizing data-dependent flexibility. First quarter 2026 reserve data shows USD share at 57.7%. Dollar dominance remains intact. Agencies have incorporated tariff impacts and supply chain disruptions into baseline forecasts. In India, GST collections for August were 1,86,315 crore rupees, in September approximately 1,89,000 crore rupees, indicating robust consumption strength. September PMIs are exceptional: services at 60.9, manufacturing at 57.7, composite at 61.0, confirming broad-based expansion. August CPI collapsed to 2.07% year-on-year, with September expected even lower, well within RBI's target band. India's GST 2.0 has rationalized tax slabs to just 4 brackets at 0%, 5%, 18%, and 40%, significantly supporting consumption ahead of the festive season. The RBI has implemented phased CRR cuts from September 6 and is actively using VRRR tools to manage liquidity conditions precisely. Our comprehensive portfolio strategy for the current environment is as follows. The repo rate stands at 5.50% with a neutral to accommodative stance, while the phased 100 basis point CRR cut from September 6 supports liquidity and improves rate transmission throughout the economy. Corporate credit spreads remain stable, with lending rate transmission improving alongside the easing cycle and active high-quality issuance. Bank credit growth is steady while NBFC and microfinance funding remains well supported. Monitor supply-led yield movements into Q3 26. For commodities, Brent crude averaged the high 60s in September and is trading in the mid-60s in early October amid softer demand and inventory builds. Gold remains elevated, with 22 carat around 10,130 rupees and 24 carat near 11,050 to 11,100 rupees through September. USD INR trades around 88.0 to 88.5, with forex reserves recovered to approximately $694 to $700 billion by late September, with orderly rupee movements supported by RBI intervention. In equities, global leaders remain resilient while India has consolidated with pronounced sector rotation and primary markets exceptionally active. Focus on large-cap leaders and selectively add mid-caps on dips while tracking earnings closely given higher global rates, tariff uncertainties, and currency volatility. We invite you to download the Tikona Capital app today, available on both iOS and Android. This is your one-stop solution to track all your investments across asset classes, mutual funds, equities, debt, gold, real estate, and more, in one comprehensive place for you and your entire family. The app features easy self-onboarding requiring just a few basic details to get started, completely seamless and paperless with no long forms or hassles. You'll get a complete 360-degree portfolio view providing a comprehensive picture of all your investments at any time, along with smart AI-driven insights to help you make better, more informed decisions with real-time updates and actionable recommendations. Thank you for your time and attention. At Tikona Capital, our philosophy is driven by creating finite, actionable solutions within an environment of infinite availability and volatility in financial products. The triangle in our logo represents this finite filtering, removing the unknowable edges from the circle, which symbolizes the ultimate unknowability of nature and markets. We're ready to explore these finite solutions in infinite possibilities together with you. Connect with us. Visit our website at www.tikonacapital.com. Explore our small case portfolios at tikonacapital.smallcase.com. Follow us on LinkedIn at linkedin.com/company/tikonacapital. Subscribe to our YouTube channel, read our blog for deeper insights, or reach out directly to our founder and CIO, Sumit Poddar, at sumitpoddar@tikonacapital.com. Let's build your wealth together with research, network, and conviction.